Last year, a self-employed graphic designer in Texas received a letter from the IRS. It wasn't random. It was about $9,200 she forgot to report. To her, it didn't seem like a big deal, just side income from PayPal. But the IRS already had the data, and that small mistake turned into penalties, interest, and months of stress. Here's the truth. Most audits don't start because of fraud. They start because of patterns. Patterns that are easier to detect than ever in 2026. Today, I'm going to show you exactly what those red flags are, with emphasis, with real examples, real numbers, and how to avoid them before they become a problem. This is not about fear, it's about understanding how the system works. According to IRS data, audit rates are relatively low, but they are not random. Your tax return is analyzed, compared, and scored. And if something doesn't match expected patterns, even if it's legal, it can trigger a closer look. Let's break down the most important red flags with real-world scenarios. You can actually recognize what to do if you get an IRS letter. Now, let's take this one step further, because knowing the red flags is one thing, but what happens if you've already triggered one? What happens when that letter actually arrives? Imagine this. You walk to your mailbox and you see an envelope from the IRS. White, official, unmistakable. No explanation, no context, just your name and theirs. You open it, and suddenly everything feels uncertain. Did I make a mistake? Did I miss something? Is this serious? Here's the reality. Most IRS letters are not as extreme as people imagine, but they are very precise. The first rule is simple. Do not panic, but also do not ignore it. Ignoring an IRS notice is one of the fastest ways to turn a small issue into a bigger financial problem. Why? Because every notice includes a deadline. If you don't respond, the IRS assumes their position is correct. And that can mean additional tax penalties, interest, all added automatically. What the letter really is, an IRS letter, is not an attack. It's a request for clarification, for verification. In most cases, they're looking at something specific, not everything, just one part of your return. For example, income that doesn't match deductions that seem high, transactions that need explanation. And they're asking one question: can you support what you reported? Real scenario. Let's walk through a real situation. You file your taxes, reporting $68,000 in total income, but the IRS has records showing $79,500. That difference comes from freelance payments you received through a platform that issued a 1099. You didn't include it, not intentionally, you just missed it. So now you receive a notice, not accusing you, but asking, please explain the difference. And now the situation is in your hands. What you must do, here's exactly what you need to do. Step 1, read the notice carefully. Identify the issue, the tax year, the deadline. Step 2, compare it with your records, your return, your income documents, your bank activity. Step 3, decide your position. Do you agree or do you disagree? If you agree, you resolve it. Pay or set up a payment plan. If you disagree, you respond with documentation, clear, organized, precise. Because this is where most people fail. Not in the numbers, but in the proof. The key principle in an IRS situation, there's one rule that matters more than anything else. Documentation is everything. Not assumptions, not explanations, proof, receipts, statements, records. If you can support your numbers, you're in control. If you can't, the IRS adjusts them. So now you understand something critical. Avoiding red flags is the first step, but knowing how to respond is what protects you. And this is exactly why filing correctly from the start matters more than most people realize. Let's look at a real scenario. John lives in Florida. He has a full-time job, earning $62,000 a year. But he also has a side hustle, Uber, freelance work, small payments through apps. During the year, he earns $12,400 from Uber and $6,800 from freelance work. That's $19,200 in additional income. Now here's what happens behind the scenes. Uber reports that income to the IRS payment platforms. May also report it. Banks track deposits. So the IRS sees this: $62,000 from his job, $19,200 from side income. Expected total, $81,200. But when John files his taxes, he only reports $62,000. That gap is automatically detected. No guesswork, no investigation needed, just a mismatch. And within months, he may receive a CP 2000 notice proposing additional taxes, penalties, and interest, easily thousands of dollars. The key insight? The IRS trusts third-party data more than your own report. If there's a record, they expect to see it on your return. Now let's talk about deductions. Sarah is a marketing consultant. She earns $78,000 a year. On her tax return, she claims $9,000 for a home office, $11,500 for travel, $6,200 for meals, and nearly $5,000 in software and tools. Total deductions over $31,000. Now here's the problem. The IRS compares her return to others in the same income range. Most people at that level claim somewhere between $8,000 and $15,000. But Sarah is claiming more than double. And it doesn't stop there. Her bank activity shows limited travel, no consistent flight purchases, no hotel patterns that match those expenses. So now, it's not just high deductions, it's inconsistency, numbers that don't match behavior. And that's what triggers attention. Now let's look at something even more revealing. Lisa reports an annual income of $45,000, but her lifestyle tells a different story. She drives a $70,000 car, pays $3,000 a month in rent, travels internationally. That doesn't align. And when numbers don't align, the system looks deeper. Bank deposits, spending patterns, unreported income. Your financial life tells a story. Your tax return needs to match that story. If your tax return looks like this: $10,000 for marketing, $5,000 for travel, $2,000 for supplies, perfectly rounded numbers, that's a signal. Real expenses are rarely perfect. They look like 4,873, 2,142. Messy, detailed, real. Rounded numbers suggest estimation, and estimation suggests missing records. Let's talk about crypto. You buy Ethereum for $8,000. Later, you exchange it for Bitcoin, valued at $11,000, and you sell at $13,500. Each step is a taxable event. Each gain matters. If you don't report it, you're creating a gap, and the IRS is increasingly equipped to detect those gaps. OC's cash business carry higher scrutiny. Imagine a small restaurant, actual revenue $180,000, reported $110,000. The IRS compares industry averages, cost of goods, payroll. If the numbers don't make sense, that triggers a red flag. Most audits are not dramatic. They happen by meal. They focus on specific items, and they come down to one thing: documentation. The IRS is not guessing, it's comparing, matching, identifying patterns. And now, you understand those patterns better than most. The difference between getting audited and staying under the radar is not luck, it's accuracy, it's consistency, it's awareness. If this video gave you clarity and helped you avoid costly mistakes, take a second and hit the like button. It helps this reach more people who need to see this. And if you're serious about understanding money, taxes, and how the system really works in the United States, subscribe to the channel, because here we don't guess. We break things down clearly and strategically. Share this video with someone who is self-employed, investing, or making money online, because they are the ones most at risk without even realizing it. And don't miss the next video, because I'm going to show you how to legally reduce your taxes without triggering any of these red flags. That's where things get powerful. I'll see you in the next one.